Welcome to the Deep Dive, the place where we sift through complicated investment presentations and press releases to give you the crystal clear analysis you need. Today, we're undertaking a deep dive into, well, really the engine room of India's retail savings boom. We're unpacking the Q2 and H1 FY26 investor presentation and press release for Prudent Corporate Advisory Services Ltd, or PCAS. You probably know them, a massive player famous for that unique B2B2C distribution model in wealth management. Our mission isn't just reading numbers, it's about understanding the DNA of this model. How does PCAS actually translate its huge network of intermediaries into, scalable, durable results? And what do these latest figures tell us about their strategy for keeping that growth going, especially when the market gets choppy?
And if you look for the single most, let's say, crucial data point in this whole stack of documents, it really highlights that durability you mentioned. PCS officially clocked the highest net equity sales in our history for Q2 FY26. Now, hitting an all-time high in equity sales during a period of market instability, that suggests their core retail base isn't just participating, it's resilient. Almost counter-cyclical, you could argue. That's the story we really need to get into today.
Resilience. Yeah, that's a great starting point. Suggests the model is built to withstand pressure. Okay, let's unpack this. Starting with the H1 FY26 consolidated scorecard. That's the half year ending September 30, 2025.
Right. So at the top line, the momentum is, well, undeniably strong. Total revenue from operations hit the 113.6 crore. That's a healthy 14.6% growth year over year. And as you'd expect, this was fundamentally powered by the mutual fund segment. Their quarterly average AUM jumped 20% year over year. That's what's driving the revenue.
Okay, solid revenue growth. That's kind of what you expect from a company riding this big financialization wave. But when we look at the profit after tax, the bottom line tells a slightly different story for the half year. PT was 105.3 crore, up 10% year over year. So growth is there, definitely. But it's lagging behind that 14.6% revenue growth. That immediately makes me ask, are they maybe sacrificing some short-term margin for market capture? Where's that investment going?
That is precisely the critical question we should be asking.
Yeah.
If you look at the recent quarter, Q2 FY26, the consolidated operating profit margin stood at 22.6%. Now, that slight lag in patchy growth does suggest a conscious choice. They seem to be investing heavily back into the business infrastructure, specifically, I think, the MFD network and the tech that supports it. What would give us some confidence that this is a smart strategic move and not just, bloat, is their historical operational leverage. If you look back, say, between FY20 and FY25, their revenue growth KGR was a strong 36.3%. And that significantly outpaced their operating expenditure growth KGR, which was 24.8%. So this historical trend shows that revenue does eventually drop faster to the bottom line than expenses rise. The current spending looks like it's fueling a distribution machine they know how to scale efficiently over time.
Okay. That context is vital. So they're essentially expanding the funnel now, betting that the operational leverage will kick in harder down the line. Makes sense. Let's shift then from the financials to the operational engine that actually generates all this. The assets under management, AUM, and importantly, the quality of those flows.
The scale is just immense. Total AUM for PCS has now crossed the Euro 100 billion mark. It stood at 1,021,146 crore at the end of September 2025. But again, the headline figure is probably less interesting than the composition. A staggering 97.1% of their total AUM in Q2 FY26 was equity-oriented, and equity AUM itself grew 13% year over year to 1,017,615 crores.
Wow, 97% equity skew. That's remarkable. But hang on, in an industry that can be vulnerable to market crashes, isn't that a huge concentration? Is that a weakness? Or does the nature of their model as B2B2C retail-focused thing genuinely make them more counter-cyclical than the industry average?
Well, that's the core competitive advantage they claim, isn't it? And the sources do provide some pretty compelling evidence to back it up. Remember that highest net equity sales figure for Q2 FY26, 3,640 crore. That didn't happen when the market was roaring. The Nifty 500 actually declined by 6.2% in the year ended September 2025.
Right, declining market, record sales. That's counterintuitive.
Exactly. The ability to pull in record net sales when the benchmark index is negative. It shows their clients are behaving differently. They're not like the average institutional or, let's say, more volatile investor. They seem consistently disciplined. And a huge part of that is down to systematic investment plans, the SIP flows.
The SIPs. Nothing stabilizes net sales like a huge, steady SIP book.
Precisely. Their monthly SIP book grew 24% year over year. It hit 1,085 crore in September 2025. And here's where it gets really interesting. Almost every second rupee flowing into equity is coming through SIPs. This isn't lump sum money that might panic and rush for the exits at the first sign of trouble. It's sticky. It's commitment-based money, often managed through an advisor.
Okay, so the stability isn't just about the product itself, it's behavioral. And it's fostered by that advisory layer. That longevity brings us straight to the mechanism facilitating this. That vast mutual fund distributor network, the MFDs. That's the B2B part of their B2B2C model, right?
Right. It's an engine of both scale and penetration. PCS has 35,200 channel partners, well-trained ones they emphasize. To put that into perspective, that's about 1/5 of all the individual ARN holders in India. The registration number you need to be an advisor, they're capturing a huge chunk of the distribution firepower.
1/5.
Yeah.
Wow. And crucially, they're geographically diverse, spread out.
Yes, present across 142 locations, covering 21 states. And they specifically highlight their focus on under-penetrated markets, these B30 markets.
Can you just clarify what they mean by B30 markets, and why does focusing there matter so much?
Sure. B30 basically means beyond the top 30 cities in India by assets. Focusing here is strategic. Partly it's encouraged by regulators like SEBI pushing AMCs to go deeper into smaller cities and towns. The fact that 21% of PCS's AUM comes from these B30 markets shows they're serious about financial inclusion. They're not just skimming the cream off the top in the big metros. They're capitalizing on this huge, ongoing financialization of savings happening all across smaller Indian economic centers. It's a massive opportunity.
Okay, that's a powerful distribution story. But managing 35,000 advisors, that sounds incredibly difficult. How do they make sure this massive network is actually productive and not just, well, large?
That's a key point. They seem to focus on nurturing their MFDs, helping them grow until they hit a sort of critical mass. And technology is crucial here, platforms like Funds Bazaar and Partner Desk. The forces give us a fascinating metric, like a performance tipping point. MFDs with AUM greater than 10 crore, they exhibit 2.73 times higher average AUM per client compared to the MFDs below that threshold.
2.73 times higher, just by crossing that 10 crore mark. So that's the magic number where an MFD suddenly becomes way more efficient. How does the tech alpha, their technology, help them get over that hump?
Well, think of it as the difference between doing things manually versus having automated high-quality service. Once an MFD crosses that 10-crore point, they're usually heavily leveraging Funds Bazaar and Partner Desk. This automates things like client onboarding, reporting, transactions, even portfolio rebalancing. It drastically cuts down their admin burden, the time they save. They can then focus on high-value stuff, client acquisition, proper advisory services. And that results in a much higher average AUM per client. What was it? 10,736 for the mature MFDs versus just 3,033,515 for the smaller ones. So the tech isn't just a platform, it's really a productivity engine designed to industrialize MFD success.
That makes sense. And it explains how they justify that operational reinvestment we talked about earlier. They're building better, more efficient distributors.
Okay, shifting gears slightly. While the mutual fund engine is clearly firing on all cylinders, the company obviously recognized the need for, let's say, durability beyond just that core product.
Right.
Which brings us to their strategy for a second pillar of growth.
Exactly. And that second pillar is insurance products. This move is crucial for, I'd say, two main reasons: diversification, obviously, and cross-selling opportunities. The share of insurance revenue has steadily climbed. It went from about 7.2% back in FY20 to 11.7% in FY25. That shows a pretty determined effort to de-risk that heavy mutual fund concentration and also leverage their existing MFD network for non-MF revenue.
And the recent quarterly numbers, they seem to confirm that this pillar is gaining real structural strength. Absolutely. Q2 FY26 saw robust performance, particularly in general insurance fresh premiums. Those were up by an impressive 32.5% year over year. This suggests that those 35,000 MFDs are getting better at cross-selling the whole wealth spectrum. They're positioning themselves as comprehensive financial advisors, not just mutual fund salespeople.
Makes sense. And speaking of expansion, the company also used inorganic growth recently to accelerate their scale. They detailed the acquisition of Indus Capital in Pune.
Yes, that was completed just last month, in October 2025.
Yeah.
A strategic move, definitely. It added significant AUM straight away, 2,104 crore in mutual fund AUM and another over 145 crore in PMSAF AUM. The total cost, considering initial and contingent payments, was around 123.75 crore.
Okay, so they bought assets, but beyond just acquiring volume, what's the strategic synergy there? How does this acquisition actually improve efficiency for PCS?
The synergy really lies in technological integration and acceleration. Indus Capital brought a solid base experienced clients, existing distribution on the ground in Pune. By folding these clients pretty much immediately onto PCS's own Funds Bazaar platform, they get two key advantages. First, the newly acquired clients get instant access to a wider, more mature product range. And second, integrating them subjects that acquired client base immediately to the efficient, automated workflow that drives that 2.73x productivity advantage we discussed. It's about rapidly converting existing assets into platform-optimized assets, more efficient assets.
Got it. So the acquisition is really about efficiency gains and tech integration, not just bulking up. Okay. Now let's zoom out, way out, to the biggest context possible. PCS frames its entire growth story within India's massive long-term economic development narrative. They call it the mutual fund route to Viksit Bharat at 2047. The projections here are almost dizzying.
They're massive, yeah. But they really define the long runway ahead for this industry. The sources project India's per capita income surging from roughly 1.8 lakh in 2024 to an estimated 16.5 lakh by 2047. That's the whole financialization story writ large, isn't it? More disposable income, more savings looking for investment avenues, and even more relevant to PCS's business. Mutual fund AUM itself is projected to grow from about 66 lakh crores in 2025 to, well, a staggering 2,791 lakh crores by 2047.
2,791 lakh crores. That's a 42-fold increase. Wow. So the current market size is really just the tip of the iceberg.
Pretty much, yeah.
Okay. Given that kind of growth trajectory, the question shifts, doesn't it? It's not if the market will grow, but can PCS maintain its market share? Can it keep growing faster than the industry average?
Well, they've certainly demonstrated significant growth alpha historically. Between 2015 and 2025, PCS's AUM grew at a CAGR of 34%. That's drastically higher than the overall industry's 20%. But, like we said, the true test of their model's resilience is during market downturns. The sources actually looked at periods over the last 15 years when the Nifty 500 index returned less than 0%, which apparently happened about 22% of the time. During those really tough times, PCS's equity AUM still saw an average annual growth of 11.1%. Compare that to the industry average, which was basically flat, just 0.2%. 11% growth when the market's down versus flat for the industry. Exactly. It's powerful evidence that this B2B2C SIP-led retail structure genuinely acts as a major shock absorber. It really confirms that resilience narrative we started with.
So what does this all mean? It feels like the story of PCS is a really compelling case study. They've built this highly scalable, pretty asset-light distribution model that seems perfectly tailored for the demographic shifts and the tech reality of India's growing middle class. It's about using technology to empower human advice, which in turn seems to foster more disciplined, long-term investing behavior from clients.
And that behavior, that's the final crucial connection point, isn't it? PCS claims its individual equity AUM held for more than 24 months is higher than the industry average by 350 basis points. So 61.6% for them versus 58.1% for the industry. Now, that difference might sound small, but compounded over years, it's massive for wealth creation. So the final thought perhaps is why? Why does this specific B2B2C model, supported by the huge localized MFT network reaching right into those B30 markets, seem to foster this longer-term, more durable investor commitment compared to the industry average? Is it the personal touch, the relentless SIP discipline, the simplified access through their platform, or some combination? And, if you are tracking this going forward, what other behavioral metrics, maybe looking at redemption patterns during major market corrections, might confirm the structural commitment to long-term wealth creation? Something to keep an eye on definitely as India's whole financialization story continues to unfold.